Okay, good afternoon, everyone. It is 2 p.m. at this time, and today we are going to be talking about Chapter 4, closing the accounting cycle. Okay, closing the accounting cycle. If you guys remember the periodicity principle that we mentioned in one of the previous recordings, that every once in a while every business have to close or have to issue financial statements, and they want to see where they are, so that comes with the in line with the same concept, periodicity. Yeah. And I'm looking at the PowerPoints at the same time, so bear with me for a minute also. Um, before we go into this, there are some terminology that we need to talk about in closing the accounting cycle. Remember, we start with analyzing transactions, recording. Then once we analyze them, that means we identify the two accounts, what categories are the two accounts, whether they are assets, liabilities, or owners equity, which one increased, which one decreased, and then at the end, which account we debit, which account we credit, and then we record it in the general journal, and we post to the ledger, and then we do some adjustments. Okay, now we're going to talk about closing the accounts. Is at the end of the accounting period, we close the accounts, and there are some accounts that are closed and some accounts that are not closed. The accounts that we close are called temporary accounts. They are called temporary accounts, and those are revenues and expenses. So when you do a post-closing trial balance, you will not see a revenue or expense in that post-closing trial balance. Uh, However, the accounts that are not closed, those are called permanent accounts. Those are called permanent accounts. They will continue from period to period until they are fully used or fully depreciated. And those are such as the assets, liabilities, and the owner's capital. Those are not closed. Okay. When we close, when we do close, remember we have to do closing entries. Closing entries are just the regular general journal entries. Like I said, we close revenues and expenses, and we close the withdrawals against the capital. Okay, we use one account when we do close. It's called income summary account. Okay, we use an account called income summary account. I'm going to be using the book a lot while we are talking about closing entries and closing the accounting cycle. I'm going to refer you to some pages in the book. So I hope by now that everybody got the textbook. Okay. Okay, we mentioned that the accounts that are not closed are the permanent accounts. Those are the balance sheet accounts, assets, liabilities, and owner's equity, especially the capital. The accounts that are closed, like we said, revenues and expenses, and those are called temporary accounts. Okay, so what do we close? Okay, we close all the when we close all expenses and we close all revenues, we close every expense, every revenue. So the expenses normal balance is usually a debit balance. So when we close them, we will have to credit every single expense, and we debit with one account is called the income summary account. Remember in the introduction we said we use in one account is called income summary account. So I'm going to show you how that looks like. Okay. All right. And I am on chapter 4. And okay, on page 141, on page 141 of your textbook, you will see there are 1, 2, 3, 4 closing entries. 4 closing entries, and this is how they look like. Okay, if you take a look over here, page 141, and these are the closing entries. Okay, these how the closing entries look like. You got it? Okay, the first closing entry is we closing the revenues. Remember, we use an income summary account, and let me use my board also at the same time, the board that you guys probably don't like, and I'm sorry for my handwriting is not that good. And here is the pen, the marker. It looks like I left it open. It looks like it's dry. It is indeed dry. Let me see if I can find another one. Okay, let's see. Let me see this one if it works. Okay, let's give it a try for this one. So the first journal entry, we close the revenues. Okay, so remember the normal balance of revenues is a credit balance. Okay, and then of course you can start with the closing expenses if you want. And so we debit revenues. Okay, we debit revenues and we credit an account called income summary. So we're going to debit. Okay, debit whatever kind of revenues you have, service revenue, sales revenue, what. Okay, so I'm just going to assume service revenue. Okay, service revenue is debited, and we credit an account called income summary. We credit an account called income summary for the total revenues that you have. Okay, now remember, you're going to be probably looking at the income statement. Okay, you're going to be looking at the income statement. All right, so we start with closing revenues. Revenues have a credit balance, and when we close it, we do a journal entry. We debit revenues and we credit income summary. Okay, and then the next, we close expenses. We close expenses. So that's one journal entry. Okay, and you're going to be looking at the income statement. You're going to look at how many expenses you have. So for this example that we have over here, we have 1, 2, 3, 4 expenses. Okay, we have 4 expenses in this example. Okay, 4 expenses in this example. Okay, you see with me, they have wages expense, they have insurance expense, utilities expense, supplies expense. Look at the journal entry one more time. Look at the journal entry one more time. They have 4 expenses. Okay, they have wages expense, insurance expense, utilities expense, and supplies expense. You see them right here. And notice they are credited. We debit the account that I mentioned. We use it only when we close income summary. So we debit income summary for the total of these expenses. Okay, we debit income summary and we credit all these expenses. So that's the second journal entry, closing entry. The first we close the revenue. The second one we close the expenses. Okay, again, revenues have a normal credit balance. When we close it, we debit it. And we credit an account called income summary. And when we close expenses, expenses have a normal debit balance, and we close them. When we close them, we credit them, and we debit income summary account, that temporary account that we only use, or nominal account, we use it only when we close the accounts. The next thing, guys, we're going to close is the net income or loss, the total, the difference between revenues and expenses. Okay, the total between. Now, if we have revenues, if the revenues are more than expenses, of course, if we have net income, with the amount of net income, we close it to the capital. So we credit the capital. The capital has a normal credit balance. We don't do the opposite here. Be careful. We're looking only at whether we have a gain or loss. If we have a gain, we credit the capital, and we debit the income summary, the one that we use, the temporary account. Okay, and we credit income summary, the capital. And if we have a loss, we do the opposite. We debit the capital. Loss means a deduction or a minus in the capital. Okay, deduction to the capital. So if we have a net income, we credit the capital with that amount, and we debit income summary. Okay, and the fourth journal entry, the closing journal entry, is the withdrawals. Okay, the withdrawals. Now remember, withdrawals, we close it against the capital. We close withdrawals against the capital. And I'm just showing you, you can look over here. Okay. The fourth, notice we debited the capital and we credited the withdrawals. Okay. The capital is debited because it's a reduction. Withdrawals is a deduction in the capital. Remember the formula, guys? The formula that we mentioned many times before? The beginning balance of the capital plus net income, okay, plus additional investment, if any, minus withdrawals. See? We say minus withdrawals. So that means the withdrawals reduce the capital or owner's equity at this point. So that's why we debit the withdrawals and we credit the income summary. So one more time, the first journal entry, we close revenues. So we're going to, since revenues have a normal credit balance, so we debit the revenues and we credit income summary. And the second journal entry is the, just please look over here. Okay, look over here, page 141 of your textbook. Okay, so the second closing entry is we close the Expenses. Expenses have a normal debit balance, and we close them, we credit them. We debit the income summary and we credit all the expenses, and we have to list them one by one. The third journal entry, the closing entry, is that the net income or loss. If we have a net income, then we would have to debit income summary and credit the capital. And if we have a loss, we would have to debit the capital and credit income summary. Okay, and then the last one is the withdrawals. The withdrawals usually reduce the capital. Therefore, we're going to debit the capital and credit the withdrawal. So these are the closing entries that you can see. All right. Okay, that's a good example of the closing entries that every business must do at the end of at the closing, when they close their accounts, the temporary accounts, at the end of the accounting period or at the end of their reporting period. Okay, so those, you got to post those closing entry to your general ledger accounts. So you're going to post the general ledger, you're going to post your regular journal entries, you're going to post your adjusting entries that we talked about before, and you have to also post the closing entries. So at the end, the income summary account will balance out. It's going to end up with a zero. Okay, this temporary account that we brought in, or we only used for this purpose, you're not going to see any expense. All the expenses will be zero at the end. All revenues will be zero at the end. Withdrawal will be zero at the end. So all what you're going to see, if you want to do a post-closing trial balance, all what you're going to see is the assets, you're going to see the liabilities, and the capital. Okay, and the capital, of course, you're going to see accumulated depreciation. Okay, like for example, if you have equipment, you're going to report the equipment at their ending balance less accumulated depreciation. Okay, there is another journal entry that is an optional journal entry, and that is a reversing entry. Reversing entry is an optional journal entry, and it is made on the first day of the new accounting period. Mostly, this journal entry that you do it for accruals. Whatever you had, for example, if you had a insurance expense, okay, and or let's say you have interest expense and interest payable that you had it at the end of the previous period. Okay, so when you start the new accounting period, so you're going to do, you debit interest payable and credit interest expense. In this case, there'll be no confusion. So everything behind you is left. You're not going to say, oh, we had interest expense before, we have interest payable. Well, so you close those and then you start again from scratch for the new accounting period in terms of revenues and expenses. Okay. Okay, if you guys, these reversing entries are also, I advise you to look at the PowerPoint as I am looking at it. It gives you those details also in that PowerPoint. Okay, also accountants at the end of the accounting period, they do work. They have working papers, and the most popular or the working paper that they use is the worksheet. Okay, and I'm going to show you this worksheet, how it looks like. Okay, on page 144 of your textbook. 144 of your textbook. This is a worksheet. This is a worksheet. Okay. 144, page 144. This is a worksheet. It's not really required, but accountants do that for practical purposes. Yeah, it serves as a preliminary step in preparing financial statements and lessens the possibility of errors. So that's what the major purpose of this one, as an introductory to financial statements, and it reduces errors. If you notice, the first column is your accounts. That's the first column. That's all your accounts from your trial balance. Okay, and this is your trial balance. The second is the trial. These are your accounts. This is your trial balance. And the green one is your trial balance. That's after you have posted, before you did any adjustments. Remember, I told you at some point you might want to do before you do your adjustments, you have to do, or you do a trial balance to see if your work is okay so far. And then when you do your adjustments, you have to post those adjustments over here. The third column, the pink. So the first thing is your trial balance, then your adjustments, and then your adjusted trial balance. The brown one is your adjusted trial balance. How did they come up with the adjusted trial balance? You're going to do a cross, what do you call that? Footing. Cross footing. You're going to go all that way, horizontally. So, for example, cash, you started with 22,480 on the cash. There is nothing, no adjustments were made to the cash, and no closing. So to the so the cash stays the same, $22,480. Nothing happened to it. Notice each column is a debit and credit, each column. Okay, but if you look at accounts receivable, you started with 4,600. That's from the general ledger or from your T account, the last balance of your T account. And if you notice that we have a debit of $400 for the accounts receivable. A debit, remember, accounts receivable an asset, and when assets increase, they are debited. So debit, so that means it's an addition to account receivable. Therefore, the balance, the adjusted balance of accounts receivable is 5,000. Okay, is 5,000, which is 4,600 plus 400 is 5,000. Okay, it looks like, remember, accounts receivable an asset, and there is no closing to it. Okay, all right, it stays the same. So this is your adjusted trial balance, and you do across every adjusting entry you made. It has remember, it has two accounts. Both of those accounts affected. For example, another example is if you look at okay, let's look at withdrawals. No, not withdrawals. Let's look at design revenue. Okay, now I want something that has the opposite. Okay, let me see. Um, well, we can look over here. Okay, look at office equipment. Look at office equipment. Well, no. I was going to give you one with the opposite, debit and credit. I was looking at, let me take a look and I'll show you. Oh, look at unearned revenue. Remember, unearned revenue, we call it a liability, guys. It's a liability. Unearned revenue started with $1,400. Unearned revenue. Unearned revenue. It has a credit balance of $1,400. Unearned revenue credit balance of $1,400. You see that? And then on the adjustments, it was debited for $800. That means there was an adjusting entry that we made and the unearned revenue went down. That means it was earned. It became earned. So there was a debit of 800. So it's going to make it a negative 600. Credit is a credit of 600. So 1,400 minus 800, and the ending balance is, the adjusted balance is 600. Okay, so this is the worksheet, guys. The first column, the first column, of course, debit and credit. The green is your trial balance. Your next columns are your adjustments. Okay, those are coming from the adjusting entries that were made, and then you do the adjusted trial balance. That means those adjustments are going to increase or decrease these numbers. So you're going to do a cross-footing. Okay. So if you have started with a debit balance and you have another debit coming in the adjustments, that means you add it. If you have a debit balance and you have a credit adjustments, that means the opposite is going to reduce that capital. The adjusted balance is going to be smaller. Okay, so this is the worksheet, page 144. Guys, I told you these first 4 chapters are very important. You need to take your time because it's accumulation. These numbers came from chapter 1 or 2. So each chapter depends on the chapter before it. It accumulates, it builds on. So that's why you need to read or study these 4 chapters word by word. Okay, that's why exam 1, I did not put no study guides for exam 1. It's coming from the first 4 chapters. Okay, all right. The next thing is closing entries. Also, closing entries, guys, they are going to be posted to the general ledger also. And like I said, you're going to end up with a post closing trial balance that looks like, let me show you. Oh, by the way, there is an excellent example, guys, for you to practice. Okay, to practice on page 149. They had the closing accounts, closing journal entries. Okay, I just wanted to show you if I find a post closing trial balance. Oh, here's one. On page 140, you will see a post closing trial balance. Notice there is not a single revenue or expense in it. There is no single revenue or expense in it. Notice is only the balance sheet accounts. Those are the permanent accounts. Okay. Okay, this chapter is not a long chapter. That's the end of this chapter, guys. So it's all about closing the accounts, and it has some details, a little bit of details about the worksheet. The worksheet, like we said, it is a helping tool. It's an assisting tool for the accountants. You don't have to do it, but accountants use it. It is very helpful. It reduces errors because you have the picture in front of you. It's the first step toward doing your financial statements. Okay, I think that will be the end of the accounting cycles between chapter 1 until chapter 4. That's the end of the accounting cycle. Like I said, these 4 chapters are the split of accounting. Imagine that you have a house and the house doesn't have a split. Okay, it's not going to last. Same thing for accounting. Chapters 1 through 4, those are the basics. If you really study, like I told you, these 4 chapters, really good. I promise you, you're going to have a solid basis of understanding accounting. So if you, once you finish with this financial accounting portion, and then you do the managerial accounting portion, those are the split. Those 2 courses are. Then if you go do a additional accounting courses such as intermediate 1, intermediate 2, you do managerial accounting, cost accounting. Those become a matter of reading. But these 2 courses, accounting 1 and accounting 2, are the basic block. If you get them, you have a nice career coming to you. And if you do intermediate accounting 1 and 2, that's probably more than half of the CPA exam. After you do financial accounting, managerial accounting, you do intermediate accounting 1, intermediate 2, and also accounting theory. Okay, sometimes it's called intermediate 3. Once you do those, that's about half of the CPA exam. If you are interested in this beautiful career, okay, accounting career. Okay, everyone, good luck. And I think that is the accounting cycles, chapter 1 through 4. My conscience is clear. I explained that to you. It's an online course, and my conscience wouldn't let me sit aside and not giving you these guidelines. But again, you have to go back to notice that I even was looking at the PowerPoints, and I was looking in the book. The book is the source, and this is a very good book. Now, when you get it, guys, this is an investment, like I said, for 2 courses. Okay, I'm not making a commercial for this book, but I've been using this book for a long time. It's a very good book. It gives you a very good details of the various steps for the accounting cycles, and it becomes more interesting after chapter 4. Okay, chapter 5 and above will become a little bit more specialized. Okay, but these are the basic rules of accounting, the first 4 chapters in this, but not yet. I mean, just a big chunk of the basic principles of accounting. But when we're done with accounting 2, That is the full split of accounting. Okay? Everyone, have a blessed day and enjoy the rest of your weekend. I hope that you all listen to these tips. If you have any questions or any concerns, like I said, please email me. Don't call me. Email me, and I'll be more than happy to set a Zoom meeting face to face with you. All right, that would be really good. Just let me know. All right, all right. Have a blessed day. I'm gonna hit industry and